I love trading during earnings because the volatility is so high, you get paid so much more premium. And remember, when you're selling options, you keep the premium no matter what happens. I'm gonna show you in this video a great trade idea for this week on a super solid company that's even part of the S&P 500, profitable, and pays a dividend. I'm gonna show you how to buy 100 shares, sell a call, and sell a put. So it doesn't really matter if the price goes up or down. Here's the thing about earnings and volatility. I don't know if it's gonna go up a lot or down a lot. I just wanna make money either way. Now, before we jump right in, do me a favor, hit the subscribe button. I'm literally putting up a video each and every single day. Make sure you catch my live streams every Monday, trading a real account, showing you all the clicks to make so you can copy exactly what I'm doing if you want to. So let's jump right in. All right, so I'm gonna walk you through the trade and I'm gonna show you exactly what to do. Now, here's a 1-year trade of HPE. And if you're not familiar with HPE, it's Hewlett Packard Enterprise, not the old HP printer and laptop company, but the enterprise IT side of the old HP company. Now, right now it's trading at $21.94. Earnings is going to be after the close on Thursday. So I'm gonna show you a trade that you're gonna hold for 4 days. So we're gonna look at the options chain like we always start, and we're gonna look at December 5th with the strikes down the middle. What we're gonna do is buy 100 shares and sell a call right away. So for example, if you were to buy 100 shares right now and pay the market price of $21.94 and then sell a $22 call expiring Friday, well, that's 83 bid and 89 ask. So we're gonna assume the mid price of $86. Your actual fill might be more or less than this. So we're always gonna start off with calculating our rate of return. So if we're making $86, we're gonna divide 86 into the capital needed to make this trade, which would be $2,194. We are literally making almost 4% on our money for 4 days. Guys, if you do a trade like this every week, you're literally making over 200% on your money. And if you don't want to put up all your money, the $21.94 to buy 100 shares, no worries. Let's see how much the margin would be. So to check the margin, we're going to actually analyze the trade. And we can see here that the margin required for this trade is actually only $659. Now, I'm not suggesting that you open an account with $659 and put this trade in, because if the stock goes down, you're going to be undercapitalized. However, if you do have a few $1,000s, this can be a very safe trade and it can be a great rate of return for you. Now, because earnings is Thursday after the close and we don't know if the stock is going to go way up or way down, we're going to be on both sides of the market. So we're going to buy 100 shares and sell an at-the-money call and collect the $86 like I just showed you. And at the same time, we're going to sell a put that's kind of far out of the money. As an example, we can sell a $20 put that has a 17 delta, so only 17% likelihood that the stock is going to fall below $20 before December 5th. And that last traded at $23. So again, we're going to calculate our rate of return, 23 divided by $2,000 to make this trade, not even using margin and putting up all the capital yourself. And you're making 1.1% on your money, again, for only 4 days time. If you do a trade like this every week, you're literally making 59, almost 60% on your money. Now, also, when we're looking at the chart, we see that this stock actually pays a dividend of 13 cents per share. Now, typically, stocks that pay dividends are a little bit more safe than stocks that don't pay dividends. They're sharing their profits with their investors in the form of dividends. So while you're holding the stock, even if the price of the stock is going down, you're still getting paid on a quarterly basis. And we can also see on the chart here that the earnings per share is about 44 cents, meaning that they are a profitable company. So worst case scenario, even if the stock drops, I can feel pretty confident it's going to go back up again. And if I have more cash in my account and the stock drops, what I'm going to do is sell another put as the stock goes lower, take in more income, and if I have to buy the shares, I'll be averaging my price down. Okay guys, how'd you like that info? Can you totally see yourself doing that? Let me know in the comments, what do you think of HPE? Do you like this stock or do you prefer a different ticker? Do you think this is risky or not so risky? If you liked the video, smash the like button, subscribe to the channel, and give me some ideas on other videos. Thanks for watching and happy trading.